Joining me now for the markets update is Simphiwe Letlojane from ABSA Investment. Simphiwe, thanks so much for your time this afternoon. Let's take a look at what's playing out on the global markets front. We saw markets in the US close in the red, but when you look at those futures, they are in the green. Choppy trade here at home, choppy trade in the US as well. Take me through what you think is moving markets today. Are we just seeing a wait and see approach ahead of the job sprint later today?
Well, certainly. I think, of course, from a macro point of view, that really does continue to be the key driver. Market focus has shifted a little bit from, tariffs, because we've seen quite a lot of de-escalations there, with the exception, of course, of the increase that we saw in the steel and auto space, where you could see tariffs increasing there. But definitely from about a month ago, we're in a much better environment. Where market's attention has shifted is now, the big beautiful bill, which essentially is proposing quite a lot of tax cuts in the US. And from a company point of view, from a corporate point of view, those definitely should go well, but quite a lot of concerns around the fiscus when it comes to the US. And I think that's really what has been driving a lot of market performance recently.
All right, let's bring it back home. Tons of numbers out today, particularly from the clothing retailers. Starting off with Mr. Price, key metrics in the green. The group also posted record revenue above 40 billion rand. What did you make of that performance, Simphiwe?
I think really strong performance from Mr. Price, also seeing a lot of market share gains. So from a competitive point of view, really well positioned, and really seeing some of the acquisitions that they have been making also beginning to bode well, as they're looking to enter a little bit more sports and the more premiumized market with Studio 88 acquisitions, and a lot of those beginning to be quite accretive. And then, of course, the company also still continuing on, expansion from a footprint point of view, and benefiting from that as well. But quite a good mix of diversification if you're looking at the underlying book, where even, from a homeware perspective, you are seeing a bit of a recovery in that particular segment as well. So fairly healthy numbers from the price.
We also saw healthy numbers out from TFG, posting an over 4% jump in revenue, and HEPS also rising at a similar margin. Interestingly, TFG's share price is up over 2%, but Mr. Price's share price lost 0.1%. Is there a reason to why markets seem to like TFG's results over Mr. Price?
I think, look, on a relative basis, if you're looking at the valuations of the two counters, on a year-to-date basis, the performances have actually been quite similar. But on a relative basis, from a valuation perspective, definitely TFG being the bit more attractive one, where Mr. Price is, trading at fairly a little bit more expensive valuations. So the good numbers from, TFG definitely boosting them there. But I think when we are looking at those underlying numbers, we do see that a lot of the performance actually came in the second half of the year, especially from a TFG Africa perspective, which is actually quite similar to Mr. Price. So there was a bit of an improvement in environment from about for the second half, so between September and March. But for TFG, when you're looking at their global regions, they're still seeing quite a few pain points there in terms of the UK and Australia. Really, the UK growth that we saw was predominantly due to acquisitions of white stuff. But if you strip out that component, fairly muted growth. So a lot of macro headwinds both in the UK and Australia.
And we know of, some local retailers that haven't been doing particularly well in Australia, but we won't get into that. You talk about the strength that we did see towards the second half of both the company's financial years. Is this on the back of, the two-pot withdrawals that we did see around that time?
Yeah, I think that definitely would have had an impact. And then, of course, the festive season as well. So
Black Friday, yeah.
Yes, tend to be, November and December tend to be boosted. But of course, It was a festive season where there's a lot of improvement that we have seen from an environment perspective for retailers. You had the two-part, you had inflation that has come down quite significantly, so real wages from a consumer perspective looking a little bit better. And what we are also continuing to see now is that we have seen some interest rate cuts. So all of those factors combined definitely, posing towards a bit of a better environment for retailers than, if we're looking about a year or two ago.
And you talk about interest rate cuts, and we've seen that really boding well for the property sector. I was reading an article today that highlighted that REIT's market cap topped 250 billion rand for the first time since the pandemic. On the back of that, we also got results out from Fairvest, an uptick in distributions. It says this was due to low vacancies. Is Fairvest a company you follow?
Look, I think Fairvest does fall a little bit outside of our radar, just particularly from a market cap and from a liquidity point of view. And when it comes to property, we do tend to like your more distribution warehouses as well, in the more specialized areas. So distribution warehouses, logistics, we think both retail and even more so office spaces do still face quite a lot of headwinds, even though there is a little bit of an improvement, of course, from an interest rate perspective, as you've mentioned, and a little bit of recovery as well, just in terms of those two particular sectors. But Fairvest does fall a little outside of our radar from an investment perspective.
Okay, so would you be looking at a company like Equitas then?
So Equitas is also a company that we do like, but again, unfortunately, that also does fall a little bit outside of our investment universe. But I think there's quite a lot of positives for that counter playing in the space of logistics, and then of course with a lot of the strategies of most of the retailers to look at online retail sales, so warehousing becoming quite important, definitely set to benefit the likes of Equitas.
All right, before we get to your stock pick, MultiChoice was out with an upbeat before markets closed yesterday. While it expects to report a loss, that loss will be smaller than the one recorded in the previous financial year. What did you make of that update, Simphiwe?
Yeah, I think with MultiChoice, really the key focus for that particular stock is really just the acquisition by Canal Plus. So we think a lot of what the share price is really reflecting currently is what we anticipate from that perspective. The company has a lot of potential, but there has been quite a lot of areas where they didn't necessarily unlock quite a lot of value and maybe lagged, some of the strong competition that they are facing from global counterparts, so the likes of the Netflix and the likes coming into South African markets and beginning to take a little bit of, their clientele. But really, we think that Canal Plus is really what's driving that share price.
Okay. All right. Then where are you seeing opportunity at the moment? What's your stock pick?
So our stock pick is Richmond. I think the company has had a bit of a bumpy ride this year, had a strong first quarter, did pull back quite significantly, especially during all the market volatility, with the trade war between China and US, and of course, China and US being one of the biggest markets that they tend to play in terms of where they generate their revenue. But with a lot of those curtailments, we definitely do think that the macro picture is slightly better now. But also just in terms of management, so a company that displays quite a lot of quality characteristics. We really did like their recent earnings results, where we saw some beats in the US regions as well as Japan. The Asia region, the broader Asia region, so the likes of China, still facing a bit of headwinds. So from a market perspective, there definitely are still some challenges that the company faces. And then, of course, from an input cost perspective, fairly elevated gold prices do also pose a bit of a headwind. But generally, we think that strong balance sheet, strong cash flow, and a very strong management team, and also just the moat around the various jewelry segments that they play in, definitely makes it a fairly good company to invest in.
All right, Simphiwe, thanks so much for your time and joining us for our markets analysis in the afternoon. That was Simphiwe Letlojane from ABSA Investments.